and the market's unchanged right now. But let's talk more about market, which is sort of searching for some direction here. Although we're 400 points off the low at the session. That low, by the way, triggered by another sign of China weakening, this time in the manufacturing sector. And not just China, by the way. Europe, particularly Italy, they continue to slow, almost on the verge of contraction there with their manufacturing. So can the market help resolve all this? Joining me now, Capital Wave Forecast Editor Shah, Raymond James Chief Investment Strategist Jeff Saut, and MaxFunds.com founder and FBN contributor Jonas Ferris. Let me start with you, Jeff. I'm really impressed with this market post-Christmas. You know, we had the biggest one-day point gain ever. Then it was followed by an enormous intraday reversal, one of the biggest reversals in history, 600 points in the last hour of trading. And then on Monday, we saw the market spurt. The Dow spurted 200 points just about in the last 4 minutes of trading. There's a certain resolve there. I'm not sure what it means, but what's your assessment?
Usually when you get markets that do that kind of dramatic action, you're usually either around the top or a bottom. And after the drop that we've had since the October 2nd sell signal, I have to think we're in the process of forming a bottom here.
Shah, let me ask you, because you know, what I find interesting is we drilled down, like Monday, the best performer by far was Goldman Sachs. Goldman, again, looking very good. On the other end of the spectrum, though, GE. GE and Goldman are both major disappointments for 2018. Is this also part of the bottom fishing process that we hear about all the time?
I think we're hopeful that it's part of the bottom fishing process, Charles, but I'm not sure that the bottom is in quite yet. The kind of rapid moves we've had to the upside leaves a huge vacuum below that, and there's a lot of investors don't have an opportunity to buy in when the markets leap forward, 5% at a time. And when they think about getting in at the higher highs, they're not worried about what if the market backs off. They don't have any profit in there, and it's hard for them to digest that. So I think they're going to look for the market to come back down a little bit. I think the market will be a lot better off if it hit bottom and stayed down for a little while and let investors get in at some of these bargain basement prices. Some stocks are actually on a tremendous sale right now, but the market, the psychology is so negative, I think investors are just scared to jump in.
On that point, Jonas, we saw individual investor sentiment crack 50 last week. The last time that happened was in 2014. The Dow was around 14,500. It went on a pretty good run, like a 13,000-point run. I know a lot of people on Wall Street believe individual investors that, that there are contrarian indicators. But could that work in reverse? Could people, including individuals, be too bearish right now?
There's definitely enough negative investor sentiment to cause a bottom. Usually that is a negative thing. When you see people pulling money out of mutual funds and ETFs like we just saw a few weeks ago, that's typically what happens when it's a good time to get in, not when it's a good time to get out. It might have been the bottom during Christmas when the president tweeted. That was starting. And it's not like it's because the economy is so hot globally. It's because it's actually not very hot globally, except it's stronger here. And now everyone's betting on the Fed not raising rates. The president just talked about it in that thing. That could drive stocks because at this point stocks are getting cheaper because alternatives are getting less yield oriented. In other words, you can't buy bonds and get the yield you could get 2 or 3 months ago. Lost more than 0.5% there, which also is helping the economy. Mortgage rates are now down to about 0.5% on a 30-year or more in many cases since a few months ago. Foreign markets are now down, like the ETFs that are trading, even though they're closed, are down. Here we're up today. Our energy sector just got saved a little bit by oil prices coming up because Saudi's cutting. That was a very hard-hit sector, so people are bottom fishing there. This could be it. And it's not going to be like, wow, everything's great, because you see tech companies, Tesla not delivering today, not looking like they're going to grow to the moon. But when you look at the alternatives, this 20% drop we had, it's already gone a few weeks ago, is looking like a pretty good opportunity to increase your stock allocation.
On that note, Jeff, one thing I've been asking all of last year, and I think we've gotten the answer so far, is no. Can the market rally without those big-time tech/momentum names? We saw the bad news with Tesla. Netflix got a major downgrade today. The target was cut by maybe 70 points at a major firm. But we're still seeing some resolve in the market. But is it possible to have a sustained rally in this stock market without leadership from tech and momentum names?
I think you will get leadership again from tech. I think some of the names are broken. and it's going to take a while to work through. But I think tech leadership will resume if this market has bottomed and heads higher, and I think you'll have some rotation into some other sectors as well.
Any sector you're looking at that might have been very much out of favor last year?
Energy and financials.
Yeah, well, that's the story today. Energy looking great, the number one performer. Financials not doing too bad again. These big banks finally showing up. Maybe Goldman's hit a bottom.